Components of a mortgage that every real estate investor should master. Hello and welcome back to Novarise, your channel for financial education. So today we're going to talk about, once again, mortgages. It's like there's so much to talk about mortgages. Everything is so obvious, but at the same time, not so obvious. So what we're going to do, we're going to dive into 4 key terms that you should really master for your benefit, because it's going to help you not only save a lot of money, but it will also help you make a lot of money from it. And what's that term? Well, it has to do with PITI, right? And when I'm talking about PITI, I'm not talking about being pitiful or anything like that. We're talking about principal, interest, taxes, property taxes, and we're also talking about insurance, okay? So all these 4 terms make up PITI, right? But out of PITI, there's 2 key terms that you should really focus on. And that's these 2 right here. And that's what most people refer to as escrow. Well, not most people, what the banks refer to as escrow. But then when you add all 4 of these together, right? This is what makes up your mortgage payment, okay? So let's just look at a hypothetical example right here. So let's assume that you have a mortgage payment that it's what? $2,500 on a monthly basis, right? So we're gonna write $2,500 right here. So out of this $2,500 on a monthly basis, how much of this money, every time that you pay on a monthly basis, how much of this goes into each and one of these 4 categories? So let's just do a simple breakdown, right? Usually, let's say, hypothetically speaking, $100 will go to the principal, because every time you pay for your mortgage payment, let's say you assume you have a 30-year mortgage, the first 15 years, most of that mortgage payment is going to go straight to interest, and very little of that is going to go towards your principal. So let's say in this case, the interest, we're talking about $2,000, right? So far we have $2,100. And so let's say on the taxes, $200. And then on insurance, we're talking about $200. So when you add all of these 4 numbers up, 100, 2,000, 200, and 200, you end up with $2,500. So $2,500, that's your monthly mortgage payment. But once you master each and one of these key components, right? So once you master what each of these numbers mean, you can actually extract money out of your mortgage payment and not only save money, but you also can generate a lot more money with it, right? So this strategy was actually talked at a very high level in an old episode, the one that you're seeing right here on the screen, but I don't want you bouncing out and watching that. I'll make sure I leave the link in the description down below so you can actually check it out. But in that video, I actually talked about how you can actually, after you sign the mortgage 6 months later or 12 months later, once you demonstrate that you have a good behavior when it comes to payments, that you can actually reach out to the bank and ask them to remove the escrow out of the payment, and you will be responsible for paying escrow separately, right? So what exactly is escrow, right? So the way it works is that every time you make a monthly payment, $2,500, this will go straight to your principal reduction, meaning to reduce the debt. And then $2,000 will go straight to the bank, because, you know, the banks are here to make money. There's no 2 ways about it. And they're pretty open about it, right? We're giving you the money, but we're also going to make money from you and interest. But then all of this, the $400 remaining that you see here, this doesn't go anywhere until the end of the year. Instead, this goes to an account called the escrow account. And the escrow account doesn't gain any interest whatsoever. It just has money sitting in there, and it's your money that's sitting in there. So that when it comes time to paying your property taxes, usually at the end of the year, or your insurance, which happens once a year, they will go to your piggy bank, to your escrow bank, and they're gonna take that money and pay for the taxes and for the insurance. But because you're responsible and you're also a seasoned investor at this point, you can actually take care of this yourself. You don't need the bank to help you, you know, take the money, take the $400 a month and put it aside, because you can handle that on your own. So you can request the bank to remove the escrow, have you personally take care of it. And now you have freed up $400 on a monthly basis, right? It's $400 that instead of having it sit on this account, on the escrow account. Now it's going to sit in your property's business account and you can do something with it. Now, I know maybe $400 might not be much of a big deal for some of you, but when you multiply 400 times 12, we're talking about $4,800 a year. That's a lot of money. You can use this money to invest in the stock market, to invest in another deal, multiply that money, generate more money, and then use part of that money to pay off the taxes and the insurance and still have money left over to do some other projects, some other investments and stuff like that. So there you have it. It might seem very small, just an escrow number, but look at the amount that you can generate just by simply asking the bank to remove the escrow and by getting yourself familiarized with the true meaning of what these 4 terms mean. And if you haven't checked out that old video I told you about, here is the video right here. Just click on here and you can watch it, and that information will help you complement everything you just learned today in this video. Until then, take care. Bye-bye.